A lot of people think that reaching $100,000 in savings is the moment they've made it, especially in Singapore. I used to think that too. But the reality is different. $100,000 is not the end of the journey. It's the point where the real decisions begin. Because if I leave that money sitting in a bank account without a plan, it slowly loses value. Inflation keeps rising, and the cost of living in Singapore keeps moving up year after year. So in this video, I'm going to break down exactly what I would do if I had $100,000 in Singapore. How I would split it, invest it, and structure it so the money doesn't just sit there, but actually starts working for me. If I had $100,000 in Singapore today, here's exactly how I would think about deploying it. First, I would acknowledge that having $100,000 in liquid savings already puts me in a stronger position than many people realize. Singapore has a reputation for high savings rates, but much of that comes from CPF contributions. When we focus only on cash that people can actually access and use, the numbers look very different. The challenge I often see is that many people work incredibly hard to reach this milestone and then become stuck. They start asking questions like, should I invest? Should I top up CPF? Should I buy property? Should I just keep everything in cash? While they're trying to decide, months or even years pass. In my experience, doing nothing is often more expensive than making a reasonable decision and adjusting later. Money that sits idle rarely stays valuable forever. The very first thing I would do is build a proper emergency fund. I know this isn't the exciting answer. Nobody likes talking about emergency funds because they're not glamorous. But I consider this the foundation of every financial plan. Personally, I would want 6 months of essential
Once that safety buffer is in place, the next thing I would focus on is eliminating expensive debt. This is where many people make a mistake. They get excited about investing while still carrying credit card balances or personal loans. If I'm paying 25% or more in annual interest on debt, no realistic investment portfolio can reliably outperform that. Paying off a credit card charging those rates is effectively the same as earning a guaranteed return equal to the interest I'm no longer paying. It's one of the few financial moves that offers certainty. And beyond the numbers, getting rid of debt creates something equally valuable: peace of mind. After securing my emergency fund and clearing high-interest debt, I would turn my attention toward investing. For most people, I believe simple beats complicated. I don't want to spend every day staring at stock charts or trying to predict market movements. That's why I prefer broad-based exchange-traded funds, commonly known as ETFs. For Singapore exposure, I would consider an ETF that tracks the Straits Times Index, giving me ownership across many of Singapore's largest listed companies through a single investment. For international exposure, I would focus heavily on global or US market ETFs that provide access to hundreds of leading companies across multiple industries. The reason I like this approach is simple: diversification. Instead of betting on a few individual stocks, I'm participating in the growth of entire markets. If I were investing a large amount like $100,000, I probably wouldn't put everything in at once. Markets move up and down, and nobody consistently knows where the bottom or top is. Instead, I would spread my investments over time using dollar cost averaging. That means investing a fixed amount every month regardless of market conditions. Some months prices are higher, some months they're lower, but over time it removes emotion from the process and creates consistency. One strategy that I think deserves more attention in Singapore is the Supplementary Retirement Scheme, or SRS.
For many years, I didn't really pay much attention to SRS because retirement always felt like something that was far away, almost irrelevant to my present life. But the older I get, the more I realize that the biggest financial advantages are usually the ones you start early, not the ones you try to rush later. What makes SRS interesting to me is actually quite simple. When I contribute to it, I immediately reduce my taxable income. That means I may pay less tax today, while at the same time allowing my money to stay invested and grow over the long term within the account. Over time, I've come to understand something that most people overlook. Returns are not just about how much my investments grow, but also about how much tax I legally avoid paying. And for someone in a higher income bracket, that difference can quietly add up to a meaningful amount over many years. Another reason I take SRS more seriously now is because rules and policies don't stay static forever. In any system, especially one tied to taxation and retirement planning, changes can happen over time. Sometimes the advantage isn't just the benefit itself, but the timing, acting early enough to lock in conditions that may not be as favorable later. After thinking through retirement tools like SRS, the next big question I always come back to is property. If I had $100,000 available, I would approach property very carefully instead of emotionally. In Singapore, the housing system is heavily supported for first-time buyers through CPF usage and government grants, which can significantly reduce the upfront cash requirement. On paper, that makes ownership feel very achievable. But I also remind myself that the real cost of property is never just the down payment. There are stamp duties, legal fees, renovations, maintenance, insurance, and long-term interest commitments that many people underestimate when they first enter the market. I've also seen a pattern where people become so focused on owning a property that they end up draining almost all their liquidity. Once that happens, they may be asset-rich on paper, but cash-poor in real life, with very little flexibility to respond to emergencies or new opportunities. Because of that, I personally prefer to protect my financial flexibility first. I don't want my entire net worth locked into a single illiquid asset too early. If I had to simplify how I would actually structure $100,000, it would look something like this in my own approach. Second, I would immediately eliminate any high-interest consumer debt. Anything charging credit card level interest is something I would prioritize over investing, because no realistic investment consistently beats that kind of guaranteed cost. Third, I would consider using SRS strategically, while the tax benefits are still available and meaningful for my income level. After that, I would take the remaining capital and gradually invest it into a simple, diversified portfolio, mainly ETFs that track both Singapore and global markets. I wouldn't try to overcomplicate it or time the market. Instead, I would spread out my investments over time, so I'm not relying on a single entry point. Most importantly, I would automate everything as much as possible and stop checking it constantly. I've learned that emotional investing usually leads to worse decisions than boring, consistent investing. Over time, I've realized something important. Building wealth isn't usually about finding the perfect investment. It's about staying invested long enough for compounding to actually do its job. A lot of people don't fail at wealth building because they don't earn enough. They struggle because their money is never properly deployed or structured in the first place. Because even $100,000 sitting safely in a bank account feels comfortable. But over time, inflation quietly reduces what it can actually buy. On the other hand, $100,000 invested with a clear structure and patience can become the foundation for long-term financial independence. For me, reaching $100,000 was never the end goal. It was simply the moment where I stopped thinking like someone trying to save money and started thinking like someone trying to build wealth.